Welcome to the research desk.
Glad to be here for this one.
So imagine waking up tomorrow morning to discover that the billions of dollars your nation had, meticulously saved in the global banking system were simply immobilized.
Just frozen with a single keystroke.
Exactly. Frozen. In 2022, that exact scenario played out on the global stage, and, well, it may have permanently fractured the foundational architecture of the global monetary system. Today, we are initiating a comprehensive briefing on a pricing anomaly that demands immediate strategic clarity.
Right, and it's a massive anomaly. We are looking squarely at the current market pricing in the precious metals complex.
We are. Gold has decisively cleared the $5,000 threshold. It touched a historic extreme of roughly $5,318 before stabilizing and holding near $5,167.
Which is just staggering price action.
It is, and the central tension we must dissect today is whether this monumental price level reflects a genuine, permanent post-2022 monetary regime shift.
Or whether we are witnessing the terminal, euphoric phase of a fear-driven, crowded trade. That is the real question.
Right. And to diagnose this, we are applying a rigorous stress test, which is silver's recent and violent price action. Silver broke aggressively above $100, driven by immense speculative fervor, only to suffer a rapid, violent retreat toward $85.
Yeah, marked by a reported 6.5% one-day drop. That was a brutal reversal.
It was. This extreme volatility in silver will serve as our diagnostic mechanism to separate structural reality from crowded trade reflexivity. We will follow the strategic framework provided in our briefing materials in strict order today.
Going through every component of the macro narrative before we get to explicit portfolio allocation targets.
Exactly. Now, my position on this is unequivocal. The breach of $5,000 in gold represents a definitive structural monetary regime shift. It is driven by sovereign balance sheet behavior and an absolute, unyielding demand for reserve collateral that cannot be sanctioned away.
Look, I understand the gravity of the price action we are observing on the screens, but I approach the mechanics of this market differently. My position is that while the geopolitical catalysts driving these moves are entirely real and historically significant, the current pricing architecture exhibits all the classic hallmarks of an emotional, flow-driven narrative loop.
A narrative loop mimicking a structural shift?
Precisely. And this is especially illuminated when we look at the structural breakdown in silver. It is drawing in vast amounts of momentum capital, leveraging compelling geopolitical headlines to justify extreme valuations. However, the foundation of gold at $5,200 is highly vulnerable to a severe reversal.
You think the narrative has outpaced the data?
I do. We are looking at a market where the underlying narrative has entirely outpaced the fundamental macroeconomic data.
Well, we will test both hypotheses systematically, beginning with the core thesis of our framework. I see why you think that, but let me give you a different perspective on the foundational nature of this market.
Go ahead.
The fundamental architecture of the gold market altered permanently after 2022. We must stop viewing gold merely through the traditional lens of an inverse real yields trade.
Because the old model is broken.
Right. For decades, the model was simple. If inflation-adjusted bond yields went up, gold went down, because gold pays no interest. But in our current macroeconomic environment, characterized by fiscal dominance and highly fragmented global reserves, well, gold has evolved.
You were saying it's moved beyond just being a crisis hedge.
Much further. We are no longer talking about a mere crisis hedge within a diversified portfolio. We are talking about sovereign insurance.
Sovereign insurance. Okay, but let's look at the data driving that.
The foundational data point that anchors this thesis is the behavior of global central banks in 2022. In that year alone, central banks purchased 1,136 tons of gold.
Which is a massive number.
It is the highest level of official sector accumulation since 1950. And when a central bank buys physical gold, they do not do it through a retail brokerage app to capture a short-term swing.
No, they execute methodically.
Exactly, often through the Bank for International Settlements or the London over-the-counter market, and they physically repatriate the bars to their domestic vaults. This represents strategic, price-insensitive sovereign bidding.
They are restructuring their national balance sheets.
Yes, regardless of the spot price on any given Tuesday. This sustained capital deployment is a structural floor that completely redefines the asset's valuation model.
I come at it from a different way because we must separate the underlying central bank behavior, which, I acknowledge is real, from the hyper-extended price action we are seeing at 5,318.
You think they are disconnected?
I think the market is currently mistaking a prolonged fear premium for a civilizational verdict on fiat currency. We must acknowledge the reality of geopolitical premiums, certainly, but we must equally emphasize their historical transience.
But history has changed since 2022.
Has it? History explicitly shows us that gold repeatedly rallies on discrete, intense shocks, absorbs massive speculative capital, and then surrenders that premium the moment the acute fear subsides.
Give me the precedents you're looking at.
Let us examine the exact historical precedents to understand the mechanics of these fear trades. We saw a spike of precisely plus 8.5% around the early 2022 Russia-Ukraine escalation.
Capital rushed into the metal as tanks crossed the border.
Exactly, anticipating a catastrophic global meltdown. Then we saw a plus 7.1% surge around the October 2023 Middle East shock. We witnessed a plus 12.3% rally during the peak of the 2019 U.S.-China trade tensions, when tariffs were dominating the macroeconomic discourse.
And the COVID breakout.
Right. Most notably, we recorded a massive plus 28.9% breakout from the onset of COVID through August 2020. During every single one of those events, the prevailing commentary insisted that we had crossed the Rubicon.
People thought the paradigm had permanently shifted.
Every single move was framed at the time as a permanent paradigm shift away from traditional financial assets, but they were spikes created by fear.
And your point is that the fear fades.
When institutional fear peaks, momentum trading algorithms and retail speculators flood the market, driving the price vertical. History consistently demonstrates that when the narrative loop of safe haven buying exhausts its momentum, when the shock becomes the new normal, the premium evaporates.
Well, to address that historical framing, we must dive deeper into the first major component of our briefing, focusing on the common ground and what I define as the first essential story of our era.
The reserve freeze.
Yes. The turning point was not a standard geopolitical shock like a tariff announcement or a regional conflict. It was the 2022 freeze of Russia's foreign exchange reserves by Western governments.
It was certainly unprecedented.
We must meticulously narrate the mechanics of this event because it transformed global reserve management from a sterile spreadsheet exercise into an urgent geopolitical survival question.
Right, it changed the fundamental assumptions.
Prior to 2022, a central bank reserve manager's primary function was optimizing yield and liquidity across a portfolio of G7 sovereign debt. They held United States treasuries, German bonds, and Japanese government bonds.
What we call inside money.
Exactly. Claims on a ledger maintained by the sovereign issuer. Managing these reserves was essentially an exercise in basis points, carefully balancing duration risk against incremental yield.
Correct, but that entire model operated on an underlying assumption, the absolute sanctity of the property rights within the correspondent banking system.
Which you trusted implicitly.
You bought a U.S. Treasury and you trusted the United States Treasury to honor that obligation, and you trusted Euroclear to settle the transaction without political interference.
Exactly. And the 2022 reserve freeze shattered that fundamental assumption permanently. Over a single weekend, hundreds of billions of dollars in Russian sovereign wealth were legally immobilized.
A complete shock to emerging markets.
It demonstrated to every central bank in the emerging market sphere that foreign exchange reserves held in the Western banking system could be neutralized overnight if their foreign policy diverged from Western consensus.
Which brings us to your core analogy.
Yes, this leads directly to the core analogy of our thesis. The demand for reserve collateral that cannot be sanctioned away, gold in its physical form, when held within sovereign borders, is outside money.
Meaning zero counterparty risk.
It carries zero counterparty credit risk and is no one else's liability. It cannot be frozen through a disconnection from the SWIFT messaging network. It cannot be immobilized by an asset freeze that Euroclear in Brussels or the Federal Reserve Bank of New York.
I agree with the mechanics of that.
By 2023, the consequences of this realization became statistically undeniable in the pricing data. Gold remained hovering near record levels despite the presence of a remarkably firm U.S. dollar and highly aggressive, elevated policy rates from the Federal Reserve,
which historically breaks gold.
Under traditional economic models, when the dollar is strong and real rates are soaring, the opportunity cost of holding a non-yielding asset like gold becomes punitive, and the price should collapse. The fact that gold demonstrated total resilience under those highly hostile conditions is the definitive tell.
So you're saying the pricing model fundamentally shifted?
The market had completely stopped pricing gold merely against the yield on a 10-year treasury. It began pricing it as an essential, non-sanctionable sovereign asset necessary for state survival.
That is a compelling argument regarding the motivations of reserve managers, but have you considered the glaring absence of corroborating evidence in the broader currency markets?
You mean the DXY?
Yes. I accept the 2022 data regarding the reserve freeze. The immobilization of those assets was indeed a historic precedent, and I acknowledge the 1,136 tons of central bank purchasing that followed.
So where is the disconnect?
What I question is your extrapolation of that specific central bank behavior into a blanket justification for gold trading above $5,000. If we were truly witnessing a permanent structural transition away from the fiat architecture, a genuine, irreversible monetary regime shift where global trust in the United States Treasury complex was collapsing, that transition should be highly visible in a sustained structural weakening of the U.S. dollar index, the DXY.
Well, to clarify for absolute precision, the DXY measures the dollar against a weighted basket of other major fiat currencies, primarily the euro, the Japanese yen, and the British pound. It is inherently a relative measure of one fiat currency against a basket of other fiat currencies.
True, it is a relative measure, but a true sovereign reserve collapse implies a fundamental architecture of confidence breaking down globally.
You'd expect them to dump dollars entirely.
If nations were aggressively dumping dollars to buy gold because they believed the dollar was structurally impaired, the dollar would decisively break down against its major trading peers. But it has not. The dollar has not decisively broken in a way that implies sovereign entities are abandoning it wholesale.
So what are we seeing, in your view?
What we are actually seeing is sovereign entities diversifying at the margins. They are taking new capital surpluses and directing a portion of them toward physical gold. But to claim that a price of $5,318 is justified by a complete reordering of global trust is a leap too far.
You think I'm conflating two different forces?
You're taking a valid foundational shift, marginal diversification by central banks into gold, and using it to validate an extreme vertical price level that is currently heavily populated by highly speculative short-term capital. You are conflating the steady buying of a central bank with the frenetic buying of a retail options trader.
Look, I am not convinced by that line of reasoning because it completely ignores the mechanics of how sovereign entities accumulate massive positions over time. They do not broadcast their intentions, and they do not execute their trades in a single quarter.
Fair enough. Let's look at the mechanics.
Let us move to the next component of our analysis to examine the bull case in rigorous detail, specifically focusing on the mechanics of structural accumulation versus temporary price spikes. To prove that this momentum is structural and not just a transient fear trade, we must look at the systematic campaign executed by the People's Bank of China.
The PBOC buying spree.
Exactly. Leading up to October 2023, the PBOC officially reported its 12th consecutive month of gold purchases. In that specific month, they added exactly 23 tons, taking their total official holdings to precisely 2,192 tons.
It's the consistency that stands out there.
The sheer tonnage is vital to understand, but the duration of the execution is the critical metric here. 12 consecutive months of continuous accumulation. This was not a knee-jerk reaction to a breaking news headline on a financial terminal.
No, it was clearly programmatic.
It was a highly deliberate, methodical, reserve-building campaign. When an entity of that scale buys exactly 23 tons in a single month, they are carefully absorbing liquidity without intentionally spiking the spot price against themselves. It signaled a long-term strategic preference for non-fiat collateral, effectively laying a concrete foundation under the market.
And we have seen similar behavior from other nations facing acute domestic pressures, which actually highlights a very different motivation than geopolitical grand strategy. It is not all about escaping Western sanctions.
Precisely. And that broadens the base of the structural bid. Let us look closely at the Turkish comparison to understand this second motivation. The Central Bank of the Republic of Turkey added over 400 tons of gold to its official reserves between 2017 and 2023.
A massive domestic currency crisis play.
Yes, this illustrates a parallel driver of structural demand, behavior driven by severe domestic currency instability. Turkey experienced catastrophic inflation and a collapse in the value of the lira. Their central bank utilized gold not just as a geopolitical shield, but as a desperate mechanism to escape complete fiat dependence and maintain a sliver of domestic financial credibility.
And they kept buying through the worst of it.
The Turkish central bank persisted in this 400-ton accumulation through massive economic drawdowns, political turmoil, and currency crises. When you combine the PBOC's geopolitical diversification strategy with Turkey's fiat escape diversification strategy, you see a multi-layered, robust state-level bid.
So you see this as steps up in value?
This brings me to another key analogy required to understand this market. Structural repricing does not happen in a straight, uninterrupted line. It is a staircase repricing.
Explain the staircase.
Sovereign states update their strategic reserve preferences very slowly, effectively building a new step on the staircase. Market participants, institutional investors, macro funds, and retail traders eventually observe this undeniable underlying bid.
And then they rush in.
They rush in, overreact to the upside, drive the price to a near-term extreme, eventually exhaust their momentum, retrace, and ultimately settle at a higher plateau, resting firmly on that new sovereign step. The monumental move to $5,000 is merely the broader market discovering and aggressively pricing in the next structural step on this geopolitical staircase.
I'm sorry, but I just don't buy that. Let me tell you why.
Go ahead.
Your concept of a staircase repricing is eloquently stated, but it provides excellent intellectual cover for what is, mechanically, a classic speculative blow-off top. You are entirely correct that central banks are buying for structure. No one disputes the PBOC's 2,192 tons or Turkey's 400 tons. The data is public and verified.
So the floor is real.
But central banks are deeply value-sensitive, programmatic buyers. They do not chase vertical price spikes. The price leap to a euphoric peak of $5,318 was actively hijacked by retail momentum and large quantitative macro funds.
You think the tail is wagging the dog here?
We have to look at the microstructure of how these prices are achieved. These institutional and retail participants are layering massive, tactical, and highly reversible bets on top of that sovereign floor. You are attributing the final $1,500 of this vertical price move to the methodical reserve managers at the PBOC, when in reality it was driven by the proliferation of zero-day options, highly leveraged futures positioning on the COMEX exchange, and a media-fueled narrative loop amplifying geopolitical anxiety.
But the sovereign floor provides the essential psychological and numerical baseline from which those tactical participants feel confident enough to operate. The funds only use that leverage because they know the central banks are beneath them.
But the baseline is not situated at $5,318. The sovereign bid might reside at $3,000 or $4,000, but it is certainly not chasing the absolute peak. This is precisely why we must shift our focus to the diagnostic stress test embedded in our framework, which is the bear case represented by the silver market.
Ah, the silver stress test.
Silver gives away the game entirely. Let us rigorously narrate the recent violent price action we witnessed in the silver market to understand the danger of narrative-driven pricing.
The break above $100?
We witnessed an aggressive, speculative break above the psychological and technical $100 level. Almost immediately upon breaching that threshold, the asset demonstrated extreme vulnerability to what I call story inflation.
Meaning the fundamentals didn't match the hype?
Exactly. The fundamental industrial supply and demand metrics of silver did not change in a 24-hour period. Yet the price suffered a rapid, violent retreat toward $85, featuring a massive reported 6.5% one-day drop.
Well, silver has always exhibited a higher beta and significantly wider volatility profiles than gold. It is a smaller market, meaning the same amount of capital produces much more aggressive price swings.
It is not simply a function of volatility or market capitalization. It is fundamentally about the nature of the capital driving the price. To fully grasp the danger of the reflexivity we are witnessing, we must look deeply into the 1980 Hunt brothers parallel.
A classic market cautionary tale.
This is the ultimate, definitive cautionary tale for precious metals operating in a narrative-driven environment. We must understand the mechanics of what happened. In early 1979, silver was trading at roughly $6 per ounce.
And then the Hunt stepped in.
Nelson Bunker Hunt and his brother William Herbert Hunt, utilizing immense amounts of margin leverage, began cornering the physical silver market and the futures exchanges. They wrapped their accumulation in a highly compelling, culturally pervasive narrative of global runaway inflation and absolute physical scarcity.
And the price went parabolic.
By January 1980, their buying had driven the price of silver to nearly $50 per ounce. That is an explosive increase of more than 700% in a remarkably compressed time frame.
Driven almost entirely by leverage.
During that ascent, the broader financial market was completely enveloped in a euphoric narrative of monetary distrust. It felt deeply structural to the participants at the time. It felt like a permanent repricing of hard assets against a failing fiat system.
Until the structural mechanisms of the commodities exchanges were deliberately altered against them to break their corner on the market.
Exactly. The narrative didn't defeat them. The reality of market mechanics did. The exchange regulators intervened by implementing Silver Rule 7,
raising margin requirements.
Margin requirements were aggressively tightened, making the cost of holding those leveraged positions exponentially more expensive. The leverage cracked, a massive margin call ensued, and the entire edifice collapsed under its own weight.
The price plummeted.
The price plummeted to under $11 within mere months, wiping out fortunes, and eventually bled all the way back toward $5 in the ensuing years. Throughout that entire 700% vertical rise and subsequent catastrophic collapse, the actual industrial demand for silver for photography, electronics, and manufacturing existed and was relatively stable.
The underlying fundamentals did not swing 700%.
It simply did not matter once the speculative narrative broke and the liquidity vanished. My core argument applying this to today's market is this. The recent 6.5% sudden drop in silver, violently rejecting from above $100 down toward $85, is exactly what crowded hybrid assets do when narrative buyers hit a sudden liquidity pocket.
You see the exact same dynamics.
The overarching story outruns the underlying data. If silver is exhibiting the exact mathematical dynamics of a purely reflexive bubble, we must logically conclude that gold trading at $5,200 is highly susceptible to the exact same reflexive loop.
That's an interesting point, though I would frame it differently.
How so?
The historical context of the Hunt brothers is vital, but you cannot simply map the pathology of the silver market directly onto the global gold market. They are fundamentally distinct asset classes that happen to share a category on the periodic table.
I think the speculative behavior is identical.
But the assets are not. Gold and silver must absolutely not be treated as a single monolithic trade. Gold possesses a credible, proven, state-level bid. Central banks hold thousands of tons of gold as Tier 1 reserve capital on their national balance sheets. They do not hold silver to back their currencies.
That is true, they do not.
Silver is a complex hybrid asset. It is part industrial input, heavily tied to solar photovoltaics, advanced electronics, and global electrification trends, and part retail trading vehicle.
It's extremely sensitive to retail flow.
The exact same alarming geopolitical headline that justifies a legitimate multi-billion-dollar sovereign gold hedge can simultaneously fuel an entirely undisciplined, retail-driven silver squeeze on the futures exchange. The fact that silver failed to hold the $10 level and experience a 6.5% drawdown does not structurally invalidate gold holding the $5,000 level. Gold's foundation is sovereign. Silver's spike was speculative.
It may not invalidate the structural floor established at $3,000 or $4,000 by the central banks,
but it absolutely calls into question the $5,200 ceiling we are currently bumping against.
You think gold is catching the silver virus?
Both metals are currently infected by the exact same narrative virus. Let us examine the next phase of our analysis, which addresses the best analogies to frame this price action and introduces the critical concept of the wild card.
While I will use the crucial analogy necessary to synthesize the recent price action and separate the noise from the signal, the storm and the captain.
Let's hear it.
Let us return to the October 2023 Middle East escalation, which, as we discussed, generated a rapid plus 7.1% surge in the gold price. Market skeptics point to that specific move and say, look, it is just another transient geopolitical fear trade.
Because that's exactly what it looks like on the chart.
I compare that geopolitical shock to a sudden, violent storm tossing a massive cargo ship at sea. The storm, the breaking news alerts, the kinetic conflict, the immediate uncertainty certainly throws the ship off its smooth path. It creates the visible, daily volatility we see on the charts.
Okay, but what about the captain?
The far more important question for our long-term strategic positioning is whether the captain of the ship, representing the collective sovereign reserve managers of the world, had already purposefully changed the underlying set course.
Before the storm hit.
Exactly. The empirical data, specifically the monumental 1,136 tons purchased in 2022 and the PBOC's methodical 12-month accumulation campaign, proves unequivocally that the course had shifted long before the geopolitical storm ever arrived. The storm merely accelerated the vessel along its new, predetermined heading toward a structurally higher price regime.
I accept the elegance of the storm analogy, but we must rigorously debate the wildcard concept outlined in our framework to understand the true risk profile at current levels.
The distinction between flows.
Yes, the wild card is the absolute fundamental distinction between tactical flows and strategic flows. We currently have two entirely different pools of capital actively lifting the identical asset price on the screens, but they possess radically different durability profiles.
Strategic versus tactical.
Exactly. Strategic flows come from central banks executing sovereign directives. They are buying physical bullion for long-term, multi-generational diversification. That capital is inherently sticky.
It doesn't flinch at data prints.
Right. A central bank reserve manager does not panic sell 50 tons of gold just because they see a hotter-than-expected consumer price index print on a Thursday morning. Tactical flows, however, are an entirely different beast.
The hot money.
This is capital coming from quantitative macro hedge funds and commodity trading advisors. They are buying highly leveraged COMEX futures contracts based on algorithmic war risk models and short-term momentum triggers.
And both the strategic physical purchases and the tactical derivative flows ultimately push the spot price higher. They exert the same upward directional pressure.
Yes, they push the price higher, but only one provides a permanent, load-bearing floor. The tactical flow is inherently reversible. The moment the headline risk fades, or the underlying momentum algorithms signal a trend exhaustion, or the cost of carrying that extreme leverage becomes punitive due to rising margin requirements,
They liquidate.
those futures contracts are dumped aggressively into the market. I insist that the extraordinary leap we witnessed from the high 3,000s directly to the 5,200 level is massively inflated by this highly reversible tactical flow.
So you think the PBOC stopped buying at $4,000?
I'm saying you are pricing gold as if the People's Bank of China stepped in and bought the final $2,000 of the move. They did not. The speculative tourists bought the top, just as they did with silver above $100, and tourists always eventually go home.
Look, I agree that we must differentiate the nature of the capital flows, but we absolutely cannot ignore that the base level from which those tactical players operate has permanently shifted upward. The fear creates the violent price spikes, but the sovereign structure creates the higher floors.
We are at an impasse on the exact valuation, but we need to execute.
Exactly. We must now translate this comprehensive macroeconomic debate into actionable, precise portfolio mandates, moving sequentially through the allocation strategies outlined in our briefing framework. We will walk through every metric exactly as prescribed to ensure operational clarity for capital allocators.
Starting with a primary asset class.
Yes, the first and sixth directives in our framework deal directly with our primary asset class. We formally mandate maintaining a strategic gold overweight. The specific, actionable target is a 5% to 10% allocation within a broadly diversified portfolio framework.
And the time frame on that?
This is not a short-term trading call. This allocation is specifically designed for a 2-year to 5-year investment horizon to allow the structural regime shift to fully express itself in the pricing.
Execution is key here.
The method of execution is absolutely critical. This exposure must be achieved via the purest, most secure vehicles available. This means utilizing allocated physical gold, the GLD exchange-traded fund for institutional liquidity, or highly selective, large-cap balance sheet strong miners.
Which specific equities?
We are specifically citing Barrick Gold and Wheaton Precious Metals as the approved equities for this exposure. We select Wheaton for its structurally advantaged streaming model, which provides high-margin exposure to the underlying metal prices without the direct operational risks of running a mine, and Barrick for its Tier 1 global assets and rigorous balance sheet management.
Let me address the second and third directives in the framework, which tackle the divergence we have debated so heavily today regarding the silver stress test.
How should we handle silver?
The mandate here is clear. You must absolutely separate the metals in your analysis. Do not treat precious metals as a single, homogeneous bucket in your risk models. They are behaving with fundamentally different pathologies.
Keep them distant.
Keep silver strictly neutral to opportunistic. It is not a doctrinal buy-and-hold sovereign asset. A market weight to modest overweight stance in silver is only analytically appropriate when 3 specific verifiable conditions align.
Rising industrial demand, exchange draws, and non-extreme positioning.
Exactly. You must see clear evidence of rising industrial fabrication demand. You must see supportive, verifiable inventory draws at the major exchanges, and you must have an environment of non-extreme speculative positioning. Currently, as evidenced by the violent rejection from 100 down to 85, that speculative positioning is dangerously extreme.
Which leads directly into the 4th and 7th directives of our execution strategy. We are explicitly directing capital allocators to aggressively fade silver when the narrative story outruns the hard economic data.
Fading the narrative loop.
If silver is moving violently based on ideological slogans about fiat collapse rather than verifiable ground-level installation data, such as tangible solar panel deployment metrics or industrial electrification reports, you must actively reduce your exposure.
Fading the spikes.
For the broader precious metals complex, the overarching mandate is to execute your rebalancing on panic, not on excitement. You systematically add to your strategic gold allocation during forced, liquidity-driven drawdowns, and you aggressively trim your silver positions into euphoric, narrative-driven price spikes.
And finally, the 5th directive. This serves as our ultimate macro trigger.
The DXY.
You must rigorously watch the US dollar index, the DXY, for a sustained structural break. A genuine breakdown into a structurally weaker dollar regime is the necessary external validation required to intellectually justify adding even more capital to the gold allocation at these extreme 5,000+ levels.
External validation of the sovereign shift.
Until the DXY decisively breaks, validating a true loss of global fiat confidence, caution at the highs is mandatory.
To synthesize our final positions as we conclude this briefing, I maintain that the post-2022 floor established by the massive accumulation from sovereign entities is permanent.
Based on the 2022 data,
the 1,136 tons purchased in 2022 fundamentally altered the market structure. Gold's newly realized role as non-sanctionable sovereign insurance has permanently re-rated the asset. The staircase repricing framework is mathematically valid, and the $5,000 level is not a speculative anomaly. It is the new operational reality for global reserve collateral in a fragmented world.
And I maintain that the substantial premium currently sitting atop that established sovereign floor is a highly fragile, narrative-driven anomaly fueled by leverage.
The silver stress test.
The silver stress test, the euphoric break above $100, and the subsequent 6.5% daily collapse toward $85 demonstrates exactly how quickly flow-driven capital can evaporate when a story fractures.
To successfully navigate this environment, one must vigilantly monitor the DXY for structural confirmation and demand absolute consistency from central bank purchasing data to find the ultimate truth beneath the price action.
It is a profound divergence in how we view the final pricing layer.
It is. As the source material explicitly concludes, and this brilliantly dictates our final posture regarding these two diverging assets. Gold is becoming insurance, silver is still too often sold as prophecy. This is the research desk officially signing off.